Materials constitute one of the most significant cost elements in manufacturing and service organizations, often representing a substantial proportion of total production costs. Effective material accounting and inventory management ensure that sufficient materials are available for uninterrupted production, while minimizing the costs associated with ordering, storage, handling, and obsolescence. Consequently, management accounting systems incorporate comprehensive procedures for ordering, receiving, storing, issuing, and controlling materials to support operational efficiency, cost reduction, and profitability. The materials procurement cycle begins with the ordering system, which ensures that inventory is replenished at appropriate times and quantities. Departments requiring materials submit a purchase requisition, which authorizes the purchasing department to issue a purchase order to an approved supplier. The purchase order specifies quantities, prices, delivery dates, and product specifications, providing formal documentation for procurement activities. An effective ordering system prevents production interruptions while avoiding excessive inventory accumulation. Upon delivery, materials enter the receiving system, where quantities and quality are inspected against the purchase order and supplier delivery note. Goods received are recorded through a Goods Received Note (GRN), which confirms acceptance of materials and provides evidence for updating inventory records and processing supplier invoices. Defective or damaged materials are identified and returned where necessary, ensuring inventory accuracy and quality control. The final stage involves the issue of materials from inventory to production departments. Materials are released through authorized materials requisition notes, ensuring that only approved withdrawals occur. Inventory records are updated continuously to reflect quantities issued, facilitating accurate cost accumulation and inventory valuation while reducing opportunities for theft or misuse. Effective inventory management requires strong control procedures to minimize discrepancies between physical inventory and accounting records. Physical inventory control involves secure storage facilities, restricted access, segregation of duties, surveillance systems, and periodic stock-taking to verify actual inventory quantities. Book inventory control relies on perpetual inventory records that record every receipt and issue transaction, enabling management to monitor inventory balances continuously. Differences between physical counts and book records may arise from theft, damage, recording errors, or administrative mistakes, and should be investigated promptly to maintain accurate financial reporting and operational control. The material inventory account records the value of materials held by the organization. Purchases and receipts increase the inventory balance through debit entries, while issues to production reduce inventory through credit entries. The closing balance represents the value of unused materials remaining in inventory at the reporting date and appears as a current asset in the statement of financial position. Accurate interpretation of inventory account movements enables management to monitor material consumption, purchasing efficiency, and working capital utilization. Inventory management involves two principal categories of cost: ordering costs and holding costs. Ordering costs are incurred each time an order is placed and include administrative processing, supplier communication, transportation arrangements, inspection, and documentation costs. These costs remain relatively fixed per order regardless of order size. Holding costs, by contrast, arise from storing inventory and include warehouse rent, insurance, deterioration, obsolescence, security, handling, financing costs, and opportunity costs associated with capital tied up in inventory. Many organizations also maintain buffer safety inventory to protect against unexpected demand increases or supplier delays, although this increases holding costs. The trade-off between ordering and holding costs gives rise to the economic order quantity (EOQ) model, which identifies the order size that minimizes total inventory costs. The classical EOQ formula, where C represents annual demand, O denotes ordering cost per order, and H represents annual holding cost per unit. Ordering quantities below EOQ increase ordering frequency and administrative costs, whereas larger orders increase holding costs. EOQ therefore provides the most cost-efficient inventory policy under stable demand assumptions. Where suppliers offer quantity discounts, management must compare reductions in purchase price with increases in holding costs arising from larger order quantities. The optimal purchasing decision minimizes the total cost of purchasing, ordering, and holding inventory rather than simply selecting the lowest unit purchase price. In some manufacturing environments, inventory is gradually replenished during production rather than received instantaneously. Under such circumstances, production simultaneously replenishes inventory while demand depletes it, reducing average inventory levels and associated holding costs. The resulting economic production quantity, EPQ, model adjusts EOQ calculations to reflect gradual replenishment and identifies the production batch size that minimizes total inventory costs. To avoid inventory shortages, organizations establish reorder levels, representing the inventory level at which a new purchase order should be placed. Where demand and lead time remain constant, appropriate reorder levels ensure continuous production while preventing unnecessary inventory accumulation. When valuing inventory and material issues, management accountants commonly apply FIFO, LIFO, and weighted average costing methods. Under FIFO, first in, first out, the earliest purchases are issued first, leaving recent purchases in closing inventory. FIFO generally produces higher inventory values during inflationary periods. Under LIFO, last in, first out, the latest purchases are issued first, resulting in lower closing inventory values during inflation. Although LIFO is prohibited under international accounting standards for external reporting, the weighted average method calculates a single average cost per unit by dividing total inventory cost by total units available, producing smoother inventory valuations and reducing price fluctuations. An increasingly important inventory management philosophy is just-in-time JIT. JIT seeks to minimize inventory by receiving materials only when required for immediate production, thereby eliminating unnecessary storage costs, reducing waste, improving quality, and enhancing operational efficiency. Successful JIT implementation requires highly reliable suppliers, accurate production scheduling, efficient logistics, and close coordination throughout the supply chain. Although JIT significantly reduces inventory investment and holding costs, it increases organizational dependence on supplier reliability and may expose production to disruption if deliveries are delayed. Consequently, effective material accounting combines sound inventory control procedures with appropriate analytical techniques to optimize inventory investment and support organizational competitiveness.